it back to menu. Now, here we go. What are we looking at? This is a bank diversified in financial services. NU Holdings make digital banking products for consumers in Latin America. All right, their business model is built on expanding customer engagement and offering multiple financial services. All right, over here, I'm currently spammed with Revolut and Trade Republic marketing slogans, and I think they are in the same business. And they earn their money through fees, interest on loans, and cross-selling products. So they do offer financial services as well. And they're more like, if I read this, they're more like a credit card or maybe a PayPal company, but then focused in Latin America. Their competitive advantage is digital banking. They boast nearly 123 million customers. That seems to be a big amount, with significant growth in Mexico and Colombia. Okay, their operational efficiency ratio dropped below 30%, showing they can manage costs well. This efficiency, combined with a focus on financial inclusion, creates a durable moat. Now, a moat is something you always want to see. And a moat for a business, why do you want to see a moat? The moat protects the business from their competitors. If somebody would arrive on the scene with the same amount of cash as they have as a market cap, can they compete with new holdings by just buying their way into the market? If you have a moat, they can't do that. And the reason why they can't do that is because this business apparently is set up very efficiently. Now, if we read something like this, don't take it for granted too much. You want to see, okay, how are they efficient? Efficiency. If I think efficiency, you want to see that their operating margins are very high, their net margins are very high. And from every dollar they earn, from every sale they make, they can keep a lot of that as cash flow. They combined it with a focus on financial inclusion. I'm not entirely sure what financial inclusion entails and how that relates to them having a durable moat. So that's something that we need to challenge. The growth ability. The company shows impressive compounding momentum. Now, from a growth perspective, that's what we want to see. Revenue grew to 3.7 billion US dollars and 85% annualized growth since 2021. 85% annualized growth is absolutely insane. If everything above is true, this could be an interesting buy. The customer base expanded by 4.3 million in just one quarter. Unsecured loans customer base grew by 56. Integrating strong demand. This growth is not flash in the pan, it's a steady climb. Well, they've been able to grow since 2021. So if they have already had 85% annualized growth since 2021, can they continue that growth for the next few years? That would be my first intuition. And let's see how management is looking at that. Management is focused on long-term value creation. Now, that's not great. That's what we want to see. They see significant opportunities in Mexico and Colombia, aiming to increase digital banking penetration. Their credit portfolio reached 24.1 billion. Now, having a great credit portfolio allows them to earn interest over the 24.1 billion, with secured lending growing 300% over the past year. Now, that's again an insane number. The strategic focus on expanding market size and product offerings signals confidence in sustained growth. Great. And a few takeaways. They have nearly 123 million customers. That seems to be a very high amount of customers. Revenue growth is impressive. And they emphasize long-term growth. Now, I like long-term growth. I like to see emphasis on long-term growth, specifically by management. And the reason for that is I don't want to sit here every day and look at the stock. I don't know who am I lying to. I do like looking at stock, so I'm someone that likes looking at it every day. But I think most people won't. So you want to see the actual management of the business that's active day to day on managing the business, looking out in your best interest, which is long-term growth. Now, is this something that we want to buy or not? We want to look at it from three questions. Is it a great business? Can we get it at a great price? And how predictable is it? Can we predict the future for this business and therefore manage a bit of our risk? The first question, is it a great business? From a growth perspective, their revenue growth, 5-year average, it's insane. So yes, from a growth perspective, it's a great business. Now, they talked about their efficiency. If we look at efficiency, we want to see, can they keep what they earn? Their gross margin is 45, almost 46%, operating margin of 25% and a net margin of 18%. A gross margin of 46. It's great. Not too impressed by it. Operating margins and the free cash flow yield is only 4.48%. For a growth business, this is actually quite okay. You would expect them to have more cost in their growth phase because they have to spend a lot on integrating new acquisitions that they do or their new business lines that they find. And they probably have a lot of tweaking to do before they get them very effective. But they seem to be able, with this amount of growth, to still keep 46% from their revenue as gross margin, 25% as operating margin, and net margin. That's what you're mostly interested in because net margin is closest to being converted to actual cash, is around 18%. For this amount of growth, that's fair. That's fair. Next up, their return on invested capital. If they get to keep almost 18% of their revenue as cash, at what percentage can they reinvest their cash and what kind of return can we expect from that cash? That's about 17%. Now, as I mentioned earlier, I'm looking for above 15. This is above 15, so this meets my expectation. And what you usually see in a growth business is that it takes a little bit of time for their investments to bear fruit. And therefore, I can expect this number to grow higher over the next few years, depending on where they are in the growth cycle. And we read before that they have been growing since 2021. So it's quite likely that their growth is decreasing, or I would expect their growth to decrease, and for this business to mature. If a business matures, growth will slink. The return on invested capital, you want it to be relatively high, and you want their operating margins to be quite effective. And this business seems to meet all those ticks. Now, if we talk about staying power and then being a financial fortress, you want them to have a low amount of debt and a high amount of cash, or they have a relation to each other. And ideally, where are we doing this? Let's go back to new. You want a business to have a high amount of cash on hand in relation to their debt. If we look at their balance sheet, let's look at a quarterly perspective. We're halfway through the year. They have 17,000. Again, this is in millions. So 17 billion US dollars on their balance sheet. That's quite a high number, and we want to compare that against their short-term debt, which is quite a bit higher. Short-term debt is something that they have to pay off in the short term, and that's something that you have to be worried about. And we can see that over the last few quarters, it has grown quite significantly. So I'm interested to see what will happen here. Now, we don't have the time to look into that right now, but if we want to buy this is something that I would want to look into, and I would want to see answers for why they increased their short-term debt by this much. Even though they have quite a lot of cash, they have more short-term debt. That's not something we like to see at all. If anything bad happens to the business, the cash flow generation stops. For a financial company or for a bank, if interest rates drop, they receive a lot of less income over their bank account. Even if they grew their customer base, if they per customer generate less interest, their revenue as a whole will drop. If the revenue drops, they will be able to keep less cash, and therefore they won't be able to pay off their short-term debt. And then they get in quite a tricky situation because they can no longer finance the growth of their business. So this is something that I would want to see more answers for. Next up, I am also interested in if they hand out more shares, yes or no. Yes, they do hand out more shares, and they take on debt. Now, from a business perspective, they want to grow their revenue, and to grow their revenue, they need cash. There are multiple ways they can generate cash. They can generate it from their operations, which they seem to do. They can generate it by taking on debt, and then you pay interest over that. They also seem to do that. And you can generate more cash by handing out more shares. Now, from a shareholder perspective, handing out shares to sustain their growth is not a bad thing as long as the growth keeps up and they can stay around. And by staying around basically means they have a moat and they have enough liquidity to finance their debt. Their short-term debt is bigger than their current cash and short-term investments. So I see quite a risk there, and that greatly diminishes the answer to the question whether or not this is a great business to own. I see quite a few risks already. Another thing that I find scary is Latin America. Now, I'm not an expert on Latin America. I know very little about what's happening there. Mexico, Colombia, it's not my area of expertise. So for me, this would already be a no. I'm not interested in this business. I don't think it's a great business from my perspective. Now, if you're someone who has more knowledge on Latin America and what's actually happening there, your opinion could be different. But you need to do your own research. You need to look at the stock from your own perspective and see whether or not this fits your investment criteria and your risk profile. For me, everything that we looked at right now, I would say, no, this is not interesting to me at all. But maybe we can get it at a great price. If we can get it very cheap, my interest could suddenly return. And I think if we look at a PE of 25 for growth, that is, they said it here, 85% annualized since 2021. That's actually relatively cheap if they can sustain that growth. But once again, they've been growing since 2021, so I would expect that growth cycle to reduce. Now, if we look at this graph, they still seem to climb higher, so maybe there is still some growth left in there, but at some point it's gonna wean off, and I don't want to be the one holding or having invested at very high prices, because you will see a few things happening. The growth will decrease. They need to stay operationally efficient. They will need to be able to pay off their interest on their debt, or they need to be able to pay off their debt. And you will see the valuation drop. If a company can grow 85% annualized, you're happy to pay a higher multiple. But if the growth takes off, you don't want to pay a high multiple anymore. And then the stock price will take a hit, even if the earnings have grown. If the multiple decreases faster, and it's a company in bad weather because they have debt, this is still not a great price. So I would like to see a higher margin of safety for this to be a great price as well. And then when we get to the third question, can we predict this reliably for the future? These are four. Let's do three. The third question, can we predict this reliably for the future? I think banks are horrible. I hate investing in banks for a few reasons. I have a hard time understanding them. And banks, whenever there is a financial crisis, are always caught with their pants down. They always have some bad asset on their balance sheet that you have no way of knowing about. You think they are very safe, that they handle their money very well. But I've seen it time and time again. If the banks see bad weather, there's always something wrong going on. That's from a retail investor standpoint, very, very hard to find out and figure out what's happening there. So banks can look really great in great times. If they have high interest, a lot of users, they make a lot of money. But the story can turn quite quickly, and then this can turn from a good investment into a bad investment on a whim. And I've talked about this before, growth and looking at South America. It's not my area of expertise, so I would stay away from this. And because this is a growth stock, this is a number that a lot of people like to see and that they can talk about at length, and that people will look at and say, oh, this is the business I need to own because they grow by 85% since 2021. So they will keep growing forever. And you're very likely to overpay for the growth, for the story. And you don't want to invest in the story. You want to invest in the statistics behind it and in the actual data that backs this up. And yes, they do grow, but I see some risks here and there. I think the story can turn, and I think this can turn into a bad investment quite quickly. So, and your holdings, fun to look at. Maybe if they manage their debt well next year, I'll keep an eye on it. But for now, I'm not interested.